Is what's stopping you from purchasing a home is that you don't have 20% down? What if I told you that you could purchase a house if you had less than 20% down and take advantage of insured mortgages using programs that are offered through CMHC, Sagan, and Canadian Guaranty? We're going to get into that today, but first, please hit the subscribe button, smash the notification bell, and continue to get our real estate videos. The reason that we've created this video is to show people all of the possibilities when looking to purchase real estate, and that you have many options depending on no matter what your savings is for a down payment. So what we want to do is explain the two different types of mortgages. Mortgage number one is a conventional mortgage. And with most lenders, what a conventional mortgage is when you have 20% down or greater. Another wonderful option is what we call a high ratio mortgage. And that is done with a mortgage default insurer like CMHC, Sagan, or Canadian Guaranty. This is when you have less than 20% down and looking to purchase a home. I know it might not make a lot of sense, but traditionally speaking, conventional mortgages may have a higher rate. Maybe you've saved $100,000 versus someone who scraped together 5%. When you see the rate sales on most of the websites or different options that you're looking, it's used as a bait and switch, and it's traditionally advertising the lowest rate possible for insured mortgages. So when you're buying a home with a conventional mortgage, meaning buying a home with 20% down, the pros of a conventional mortgage is you have more equity in your home. It lowers your borrowing cost, lower mortgage payments, and more flexibility when it comes to products. If you are self-employed, a conventional mortgage may help us get different exceptions that we may need and open it up to different products that lenders offer. If your ratios are out of line, meaning the amount of income that the banks allows us to have compared to the expenses going out, we are able to get exceptions on those ratios if you're on a conventional mortgage. Or maybe you have bruised credit. A conventional mortgage is attainable if you have bruised credit. The cons of a conventional mortgage. Well, it's a higher initial out-of-pocket cost and potential for missed investment opportunities. And it's very important to understand if you want to get into home ownership, don't chase the down payment. The longer you wait to get into the market, the house prices will continue to rise. And you could constantly be trying to get to 20% down, and you're better to get in a high ratio mortgage scenario. So that leads us to buying a home with less than 20% down. The pros of getting an insured mortgage through CMHC, Sagan, or Canadian Guaranty. You have a lower down payment. The minimum down payment that you're able to obtain and buy a property is with 5% down. You can get a lower interest rate. It is a very competitive space, so lenders have deeper discounts. They offer these deeper discounts because they want these mortgages to be placed on their book because it's insured and there's less risk to them, and they're able to extend that as a rate deduction. There's also the potential to enter the housing market sooner and start building equity than saving for that down payment. And the cost of these insurance premiums are not paid out of pocket. They are a certain percentage depending on whether you're putting 5 to 10% down, 10 to 15% down, and 15 to 20% down. These all vary and they are added on to the mortgage, and you do not have to pay these out of pocket. A higher premium, a 4% premium, is a large amount. And that is used when you're putting down 5 to 10%. Some of the cons of using a default insurer. Well, there's high premiums. If you're putting 5 to 10% down, you're getting a premium of 4%, which is a large amount. The overall borrowing costs due to the insurance premiums, you have less flexibility on the product, and they have very, very strict guidelines that we are not very successful at getting exceptions on. Some things to consider is the total cost over time and the equity that you build over time if you are able to get in with a conventional mortgage. How market conditions will affect your decision if you need to use an insurer to get into the market. The benefits are greater than trying to save for the down payment. Something to consider is that we've seen policy changes, so you would hate to miss out on the opportunity to purchase real estate with less than 20% down if there's a policy change and you're not able to take advantage of these situations. Also, if the opportunity arises that you want a cottage or a second home, you are also able to buy a second home with as little as 5% down. A lot of people don't understand that, and they think that 5% down only applies to first-time home buyers. So there you have it. Hopefully that makes you understand the difference between a conventional mortgage and a high ratio mortgage. If you have any questions whatsoever, please go to meetjustin.ca or click the link below, which will allow you to book a strategy call with me, and we can discuss all of your options. My team and my preferred partners will give you the local competitive advantage in today's real estate market. Thank you.